Wall Street is full of noise, with headlines flashing by the second and investors constantly searching for the next big story. In this whirlwind of information, it's easy to overlook the subtle signals that can foreshadow major shifts in the market, but every so often, a warning emerges that makes everyone pay attention. It's the kind of signal that cuts through the chaos and forces even the most seasoned investors to pause and reconsider their assumptions. That's what's happening with automatic data processing, ADP, a company long seen as a fortress of stability and steady returns. For decades, ADP has been a pillar in the payroll and human resources industry, weathering economic storms and consistently rewarding shareholders. Now, concerns are rising about ADP's recent spending habits. Investors and analysts alike are scrutinizing the company's financial statements, looking for clues about what's driving this change in behavior. Some analysts suggest this blue-chip giant may be stepping onto shaky ground. The question on everyone's mind, is ADP risking its reputation for the sake of growth, or is there a deeper strategy at play? The heart of the issue: a potential profit trap, where a company spends big but doesn't see profits rise in step. This can be a dangerous cycle, especially for companies that have built their brand on reliability and consistent performance. On the surface, it looks like growth, but if those investments don't pay off, they can erode the company's financial strength. Over time, this can lead to shrinking margins, missed earnings targets, and ultimately, a loss of investor confidence. For a company like ADP, known for its stability and reliable dividends, this is a red flag. Shareholders who have come to expect steady income may find themselves facing unexpected risks. Why would a market leader suddenly ramp up spending? Is it a sign of confidence in new opportunities, or a reaction to mounting pressure from disruptive competitors and changing technology? Is it a smart move to stay ahead of tech-savvy competitors, or a desperate gamble that could backfire? The stakes are high, and the outcome is far from certain. In this video, we'll break down the facts behind these warnings, separating speculation from reality. We'll look at what's really happening inside ADP and what it could mean for the broader market. We'll explain what a profit trap is, how it can sneak up on even the most established companies, and why it's so important for investors to recognize the warning signs early. And we'll dig into ADP's financials to see if there's real cause for concern. Are these spending patterns a temporary blip, or do they signal a fundamental shift in the company's strategy and risk profile? For anyone relying on safe dividend-paying stocks, ADP's story could signal a bigger shift in the market, one every investor needs to understand. As the landscape changes, staying informed is more important than ever. To truly understand why these warnings about ADP matter, we need to take a step back and look at the bigger picture of dividend investing. Dividend stocks are often seen as the foundation of a stable portfolio, especially for those seeking steady income and long-term growth. They're the bedrock that many investors rely on to weather market storms and provide peace of mind during uncertain times. And to appreciate the significance of these warnings, you need to know what ADP truly represents in the world of finance. Founded in 1949, ADP has grown into a global powerhouse, serving as the backbone of business operations for countless companies. It handles critical functions like payroll, taxes, and human resources for organizations of all sizes across the globe. These services are not just helpful, they're essential. Even during economic downturns or periods of uncertainty, businesses still need to pay employees and manage compliance. This makes ADP's business incredibly resilient, able to withstand challenges that might topple less essential companies. What sets ADP apart is its business model, which is built on long-term contracts and a steady stream of recurring revenue. This approach creates a reliable cash flow, allowing the company to plan for the future and invest in growth, even when the broader economy is struggling. Thanks to this consistency, ADP has managed to increase its dividend payout for nearly 50 years in a row. This remarkable track record has earned it a coveted spot among the dividend aristocrats, a select group of companies known for their commitment to rewarding shareholders. For investors, ADP is the very definition of a blue-chip stock. Large, stable, and reliable. It's a name that inspires confidence, often forming the core of conservative investment strategies. This is the kind of investment people count on to fund their retirement, to provide steady income year after year, not for chasing quick profits, but for building lasting financial security. That's why the mere suggestion that ADP could be a profit trap is so jarring. It shakes the very foundation of what many believe to be safe and dependable. If a company like ADP, long considered the gold standard of safety, is suddenly at risk, it forces every investor to pause and reconsider what truly counts as secure in today's ever-changing market landscape. A profit trap is simple. A company spends heavily on new offices, staff, or acquisitions, but profits don't keep up. Revenues might rise, but costs rise just as fast, squeezing margins and leaving less profit for shareholders. For dividend payers like ADP, this is dangerous. Dividends come from profits. If profits stagnate while spending soars, the company may have to dip into debt or reserves to keep paying shareholders. That's not sustainable. Eventually, if new investments don't deliver, the company faces a tough choice: cut the dividend or keep draining resources. For ADP's millions of investors, the risk of a profit trap threatens the very foundation of their investment. What's changed at ADP? The company, long recognized for its steady, conservative approach to business, is now making headlines for a bold transformation. In the past, ADP was known for careful budgeting and incremental improvements, but today, it's embracing a new era of ambition and innovation. The company, once known for cautious spending, is now rumored to be on an aggressive multi-billion-dollar modernization push, upgrading tech, expanding globally, and reimagining its core business model. This isn't just about keeping up with the competition, it's about setting the pace for the entire HR technology industry. ADP is actively acquiring innovative startups to stay ahead in HR tech, seeking out fresh ideas and disruptive technologies that can give it an edge. These acquisitions are designed to inject new energy and expertise into the company, helping it adapt to rapidly changing market demands. This means big investments in R&D, hiring top tech talent, and building teams that can deliver next-generation solutions. The company is betting that these investments will pay off in the long run, even if they require significant upfront costs and a willingness to take risks. Integrating new acquisitions is no small feat. It requires aligning different cultures, systems, and visions. These moves are costly and take time to pay off, but they're essential for building a unified, future-ready organization. There's also increased spending on sales and marketing to fend off competitors and capture new markets. ADP is ramping up its outreach, launching bold campaigns, and investing in digital strategies to strengthen its brand and attract new clients. The big question is whether this spending is truly targeted and strategic, or if it's a scattershot attempt to keep up with fast-moving rivals. Is ADP making smart bets, or just reacting to industry pressure? Some analysts worry that without a clear, focused plan, these efforts could become unfocused, diluting the company's strengths and leading to missed opportunities. If ADP is forced into a price war, or overpays for acquisitions, profits could suffer. High R&D costs, risky deals, and the pressure to deliver quick results could put a strain on the company's financial health. Rising marketing spend and aggressive growth tactics could signal a shift from stable, predictable growth to chasing expansion at any cost. A classic profit trap scenario. The coming months will reveal whether ADP's bold new strategy is a masterstroke or a risky gamble. To spot trouble, analysts turn to the balance sheet, the first red flag: rising debt. If ADP is borrowing more to fund its ambitions, interest payments eat into profits and increase risk, especially in downturns. Another warning sign is ballooning goodwill, created when a company overpays for acquisitions. If those deals don't deliver, ADP could face massive write-downs, signaling it overpaid and hurting reported profits. Finally, cash flow is key. If operating cash flow stagnates while investment spending soars, it means the core business isn't generating enough cash to support new strategies. That forces reliance on debt or reserves, never a good long-term solution. These subtle clues could validate Wall Street's concerns. Blue-chip companies are prized for their steady profits, strong balance sheets, and unwavering dividends. ADP has long fit this mold, with a history of profitability and a commitment to returning capital to shareholders. But aggressive spending, rising debt, and the risk of a profit trap challenge these standards. If profits falter, the dividend could be at risk, undermining the very qualities that made ADP a blue-chip icon. Investors now have to ask, does ADP still meet the blue-chip standard, or is it drifting into riskier territory? The answer will shape how investors view not just ADP, but the entire landscape of safe dividend stocks. For many, the big question is ADP's dividend safe? Nearly 50 years of increases have made it a cornerstone for retirees and income investors. A cut would be devastating. The key metric to watch is the payout ratio, the percentage of profits paid as dividends. A rising payout ratio, especially if profits stagnate, signals strain. If it climbs too high, ADP may have to borrow or cut the dividend. Credit ratings matter too. If debt rises and profits weaken, agencies could downgrade ADP, making borrowing costlier and further squeezing profits. While a downgrade doesn't force a dividend cut, it's a warning sign that the company's financial health and its dividend may be at risk. The ADP situation marks a turning point for income investors. For decades, the strategy was simple: buy blue-chip dividend stocks and hold. But now, even the safest names face new risks from rapid technological change and fierce competition. Today, investors must look beyond past performance. It's crucial to scrutinize company strategy, financial health, and the real return on investments. The days of set-it-and-forget-it dividend investing are fading. ADP's story is a wake-up call. No company is immune to disruption. For those relying on dividends, the lesson is clear: trust, but verify. Dig into the numbers, stay informed, and be ready to adapt. The ADP warning is a cautionary tale for all investors. It highlights the tension between investing for future growth and maintaining current profitability. ADP's reputation for stability is now being tested by concerns over aggressive spending and profit traps. The company's next moves will determine if it can reinvent itself or if it risks eroding shareholder value. For investors, this is a time for vigilance, not panic. The case for ADP is more complex than ever, and the stock now carries risks that weren't obvious before. The lesson: no investment is risk-free. Stay informed, diversify, and remember, caution and diligence are more important than ever in today's fast-changing market.